Hi, everyone. Thanks for joining us today. I'm Allyson Silver, Senior Director of Investor Relations with Club Capital, and I'm here with Darin Davis, Principal of Club Capital, to present a webinar for you today about the priority and profit of preferred equity investments.
Yeah, and I want to point out, by the way, guys, thank you for joining us. We're going to spend about the next half hour kind of defining what preferred equity is. And the reason why is over the last 10 or 12 years, there has not been a need for preferred equity. It's has been one of those things that's kind of set to the side, a tool that wasn't used or needed just because interest rates were so low. But today times have changed. So we've been getting a lot of requests to give a little bit of an education on why we're doing what we're doing. So we thought we'd put this webinar together and talk about really what pref equity is, how it can work for you, and the benefits for us as investors and the sponsors going forward.
Before we dive into that, I just want to provide a little background. Club Capital is an Austin, Texas-based real estate investment firm focused on multifamily investing through developments, acquisition, through a preferred equity investment platform. And Darin, you want to talk a little bit about your background?
Yeah, I got into real estate literally 2002, 2003-ish. And I've done a little bit of everything. I started off probably like a lot of people did. I was self-taught and started off on single family. And as things progressed, I did some retail syndications, some land development. I did our first multifamily in 2009, 10, 8, 9, 10, and never looked back. Been very proud of what we've accomplished over the past decade. And I'm really, quite frankly, I'm looking forward to this opportunity that we're in right now. When 2008 and 9 was happening, I didn't think it was an opportunity. I was going, oh boy, but learned a lot, and we're carrying that knowledge forward. And we have some really interesting things to talk to you about, and I think some great opportunities.
Darin, so as we kind of dive in, we're going to talk a little bit about the road to 2024 and kind of where the market cycle has led and what we're experiencing today and how that translates into the way that we pursue new investments and new opportunities going forward.
Yeah, so let's just kind of level set what's kind of going on right now. And you guys all know this, but I think these are just key points to remember as we go through the presentation here. The cost of borrowing. And I even said this a year ago at least, that even if the Fed rates started coming down, and they were projected to come down 75 basis points this calendar year, that's going to barely move the needle. You have so many other things going on. You've got some oversupply in certain areas, valuations are down, rents are flat. So you got a lot of things working against you. So, 25, 50, 75 basis points, not that big a deal. And it looks like as of today, based off of where inflation is today, I don't think we'll see 75 basis points. We might see 25, or we might see nothing. The other thing, I think if people don't understand this, the amount of loans that are maturing over the next 2 to 3 years are significant. I just got off a call this morning with a group, and commercial real estate as a whole in the next 12 months, literally, 12 months from now, $1 trillion of loans maturing. Now, multifamily's a part of that, and we'll get into that a little bit later. But that's happening, and we all know that. And the thing that I want to point out, when we put this presentation together 2 months ago, and I like the way that we have appears to have peaked on inflation, it's ticked up. And I think that's causing the Fed a little bit of a problem on what they do. So, and I think inflation is, quite frankly, higher than what they say, but, I don't know how we're going to do that. But I think there's a couple other things I want to point out. Loan activity way down, transactions way down. We all know that. You just can't pencil the deals to work financially. So the transactions just aren't happening. Development, kind of gone. I mean, we've been supporting developers, from a private equity, from a LP equity and co-GP. We're not general contractors and developers specifically, but we've seen that just fall off the face of the earth, as it should. There was a lot of supply. And I think the final thing is that I don't think since the pandemic that costs have actually stabilized. I think there's still issues with certain areas, i.e. concrete being one of them, even though lumber's kind of come down a lot. and flattened out, but other expenses are really high.
Mhm.
And other materials are really high and hard to get. So, these are all the obvious things, but we just want to point those out because I truly believe 24, this all stays in place. I think the first half of 25, it starts to soften. But we're kind of hopeful that by the end of 25, a year from now, plus that we start seeing a lot of, of these 6 major issues that we're facing start to more normalize.
Right. We're gonna talk a little bit about these details further on in the presentation, but really kind of here's an overview of the capital stack and preferred equity. Here's an evolution of how we've seen this capital stack transition from about the 2021 and previous timeframe to what it looks like today. So why don't you dive into this a little bit?
Yeah, it's pretty simple. If you look to the left under 2021, that's what our capital stack looked like. I mean, we had senior debt, which was bank debt from an acquisition or construction, and then you had the common equity come in. Pretty simple. Money's been cheap for the past decade. Now, when that started to change, starting at the end of 21 and current 23 and on to 24, banks pulled way back on how much money they were going to provide on that senior loan. I mean, I've seen stuff down, this example says 60%, but I'm seeing, lenders stopping at 50%. Well, the developer either start a project or go refinance that, which we're going to talk a lot about because loans are maturing. They've had to find this more or less rescue capital, and that capital is the preferred equity. So they can't fill that capital stack with all common equity. They couldn't do it. People are going to, doesn't work. Values down, interest rates high. So that pref equity is slid in there, and that pref equity sits in a senior position to the common equity. So it is paid out prior to, and it's a fixed rate of return. So you'll contract for, investor will receive a 12% annualized return paid quarterly. So that's where we're sitting with preferred equity, which we'll talk a little bit more, not only about the advantages of just preferred equity, but where that will position us going forward.
So kind of leading into that, and we're going to go over the kind of the background a little bit, but let's highlight the cycle of emotions when it comes to where we are in today's environment, considering all of those factors you started off with, inflation and value depreciation and so forth, and interest rates.
Yeah, I've said this to my kids and to myself. I say this all the time. And I admit it, I've never really made a good emotional decision. If it's based off of emotion, I'm not thinking about the data and the facts, but the headlines are going to give you the worst case scenario to get eyeballs, onto the media. But if you look at this graph actually follows the data, okay? In a sense that if you look at over to the left, the maximum financial risk, that was really about 2021, maybe 2020 when the pandemic started, but everything was peaking. We're at the height of a 10-year bull run, which was, a long one. But when it started coming down, people were committing a lot of capital to new projects and acquisitions on short-term loans. Well, here comes the decrease in, what's going on from, oh no, I'm in trouble. My investments are cratering. I'm desperate. What do I do? Do I sell? What do I do? Then you go into panic mode. And you're sitting here going, this is an emotional decision I'm making. Well, if you look to the bottom right, we're just about somewhere in the bottom of that trough, okay? Are we into hopelessness? I don't think so. Are we into the maximum financial opportunity? Probably not, Are we in the depression stage? Probably. But if you look at the data, which we're going to go through some of this, you're going to see that I think we're somewhere between the bottom of that trough into the depression hope stage. And we'll really know by the end of this year kind of where we are or where we're going.
Right. And I mean, market cycles have proven when you're at that lower cycle and emotional state, there's opportunity. So,
and there is. And the point I want to say is now is not the time to be sitting on your hands. 2 years ago was the time to be sitting on your hands. Now,
Can you time the market perfectly? No, but if you can find your sweet spot or you're comfortable with the data, our data and the data you need to do on your own, but we're somewhere in that bottom part, hopelessness all the way over to hope. Yeah, somewhere in that trough. And I'll just go from experience. I sat there in 2008, 9, and 10, did a project, did not have the data that I needed to make the great decisions. I got super lucky. That project ended up being one of the biggest performing assets we've ever done here. The point I want to bring out is I wish I'd have done 3 or 4 more. I didn't act then. I'm not going to miss out this time.
So let's dive into the data and how that information and statistics indicate our our drive for the types of projects that we do and where we focus our investments and what we do as a company.
Yeah, and I think we're going to focus, guys, and we're going to focus not on a little bit of national data, but we're going to focus on Texas and Florida. One, we're based in Texas and we have resources in Florida, and we like the 2 states because they're real similar. Yeah, when it comes to multifamily investing. So we'll stick with data in there. The first one, guys, is really straight up, forward, simple. And I think we all know this. If you look from the United States Census Bureau, if you look at 2022 to 2023, the net migration, be it positive or negative, if you look at the kind of dark green, dark blue, you see Texas and Florida. They both were the 2 winners, 2 of the biggest winners in net migration. On the flip side of that, if you see the orange and red, they were the net losers. And I think we're all fairly aware of this, but we look at Texas and Florida, net migration is coming. It has been, is projected to continue coming because it's a lot of things. It's a business climate, it's the cost of living, the affordability component, and just the quality of life. And we're getting a lot of people moving to Texas and Florida, and that's renters moving to Texas and Florida.
That's right.
Yeah, so much so if you look here, 58% of the top 10 states are represented by Texas and Florida. So just to narrow that number down a little bit more and show you what that means, as the top 10, we're well over half between those 2 states. And again, Texas leads the way. And I just thought about that. I said, Texas produces jobs. We have a great business climate here. We've got a great business economic climate here. So jobs, and you can see right there about the corporate relocations in 23, and that's just a sample of them. Yeah, statewide, just not to oversimplify this, but Texas has 55 of the Fortune 500, over 10%. And if you look at years 23 on the left to 22 to 21 and 20, you see the number of corporate relocations. And what's interesting, if you look at 2021, what I noticed there is that businesses were looking at how in the world can we run a business in a state that locks us down versus states that are being more, practical about how they run their businesses and how they run the state. And in 2020 and 2021, you can see 79 and 42 corporate relocations. The big ones there, Tesla moved to Austin from California, Oracle from California to Austin, Hewlett Packard to Houston. So big brands, those are big moves. That's not small stuff. So, that just goes to show you that, Texas is open for business. Let's talk about the job markets. If you look at the job gains in Texas and Florida, they combine for 6 or 63% of the job gains over the last 5 years. Dallas leading that in Texas, in Houston and Austin, 2 in Florida being Orlando and Tampa, and then Fort Worth running in there at number 9. But between those 2 states, and there's 6 of them, and 4 of them right here in the state of Texas. Do you want to take this one?
Sure. So, in addition to information about all the population moving to our target areas, I think it's important to focus on construction, what that means for rental housing. So Here we have shown a national graph on the multifamily construction starts in the United States. And what we really want to draw your attention to is, of course, following market cycles back in 2009, the depreciation of construction starts and how that's ticked up over the past couple of years. I'm sure if you're following publications, you're hearing about the supply, oversupply, but what the important factor to recognize is going forward in 2024, and especially through the next couple years, you're going to have a reverse of that graph, and construction starts have really, really tapered off.
Yeah, I mean, just here in Austin, we've had, and that's a national graph there, but I mean, we're replicating that. We've had a 70% decline in construction permits for multifamily.
Mm-hmm.
And what you're going to see, and Allyson points it out, 2009 to 2024, very similar. And I think in 2026, just like you're seeing in 2011 and 12, you're going to start to see that supply has cratered, but demand is still happening. The supply is going to be absorbed, no new products being built, and we're going to see the same hockey stick effect with construction, supply, demand, rents, prices, everything. And putting us in a very, very, very good position over the next 2 years to get ready for that next surge.
Yeah. So in addition to what we focused on, and that's jobs and population migration into the state of Texas and Florida, this is a representation of the construction starts that really mimic that national graph. What's shown right here is the construction starts in the state of Texas, which basically map that pattern, as well as Florida.
Yeah, I mean, and you can see the same story. You know, we're not an outlier. You know, it's a national, we could go just about anywhere, probably 40 of the 50 states, it would look very similar. So I think this is where we need to spend a little bit of time. I think it's super important because in that last graph, you showed us kind of bottoming out sometime in 24, maybe 25. But what I want to point out here over the national Texas and Florida markets, if you look at 2026 and highlighted in the yellow, that is where the pivot starts to happen on supply has been absorbed and demand is outpacing supply.
Mm-hmm.
Okay. So you can see right there each year what's happened in real time and then what's projected. So of course, right now, 2023 and 2024, we have more supply than demand. Well, look what happens in 25, goes about even, 26, it flips.
Mm-hmm.
And that's where we're trying to position ourselves. And we'll talk about that strategy a little bit later. But that 26, 27, 28 is where we need to position ourselves to be in the right spot at the right time.
Right. And so kind of digging into, again, the Texas and Florida information.
Same thing. Yeah. You can see 2026, that's
Really
where it
the
starts.
pivotal year.
Mm-hmm. Same thing in Florida. And again, these are not unique to the nation. I think, you know, like I said, probably 40 of the 50 states follows something similar to this. But I think that all the other things that we have from the migration, cost of living, affordable, quality of life really is going to support our economy as we grow.
So how does that translate into rent growth and how that's projected?
Yeah, this just follows every other chart right here. I mean, you can see it, all the numbers are starting to match up. You know, you can see what's happening in rent growth, Florida, Texas, the United States. It's dropped off significantly, but that's because we had a lot of supply come online 21, 22. And we're going to bottom out sometime in 24, 25. And then we're going to see that hockey stick effect where rents start increasing. When we showed the slide back, what was going on in 2008, 9, and 10, and when the rental rates or the demand for housing or just everything was starting to hockey stick, I remember years where rent rates were going up 7, 8%, 12, 15%. Now, do I think that's going to happen again? Probably not, but I am fully prepared to accept a number of 6, 7, 8% for a period of time. And that, if you can do that, 2 out of 3 years or 3 out of 5 years, and you get normal rent rates at 2 and 3%, you're in the right place at the right time.
Another thing we want to kind of focus on when we consider rental housing and the demand for housing is just the affordability gap between home ownership and rental. You know, nationally, that gap back in 2023 between the cost of owning and maintaining a home with insurance costs, maintenance costs, taxes, was about $1,100 between average rental rates and average mortgage payments. That gap today is closer to $1,300. And you know, while this is a national figure, it's very, very close to what we're seeing in all of the target states and areas that we focus our investments in.
Yeah, and a lot of that's to do with inflation, you know, over the last year and a half. And I really want to point something else out. Everything being equal, taxes, insurance, mortgage payment, and then rent, you still have to come up with a down payment of 10 to 20%. Now, if you look at where, and you're going to get into this a little bit later, where wages are and where acquisition of a house is, it's the gap's getting further and further away. So that's a great one.
Yeah, and I mean, on that note, we have some data here. Households that even qualify for a loan to purchase a home. So as you can see, you know, obviously as interest rates have gone up and your mortgage payment has gone up, basically you're right about 50% today on the number of households that even qualify versus who could qualify for a home loan 10 years ago.
You know, I don't know if I'm a Gen Z or a Gen Y or whatever it is, but these guys that are trying to get a home today that are 25 or 30, that is incredibly difficult to come up with that payment, the cost of housing, the affordability component. And for them, I feel for them, but for us as investors in multifamily, it bodes very well that we're going to have a supply of renters for an extended period of time. And I don't see that changing anytime soon.
What does that mean for timing and how we utilize all of this data, how we utilize the time we are in our market to find opportunities? You know, you had touched on loan maturities. So.
Yeah, I don't think I can stress enough the impact of this slide and some just current information I got this morning. It's right in line with what we know. And if you don't know this, I think this is super impactful, but I think most of us do. You know, the amount of loan maturities that are happening, you know, now and for the next 2 or 3 years are significant. If you look at, you know, what we're highlighting here in the blue is $600 billion in multifamily mortgages that are coming due. And what's happening here is this is creating the opportunity for the preferred equity. And this is something that we're very aware of. And we started looking at this 1.5 years ago, understanding this data right here, that what are these developers going to do when these loans mature and they got a rate at 3.5 and now that rate's at 8. How are they going to support that? And that's exactly how the pref equity has been resurrected to come out and say, hey, here's the way you solve this problem.
So the way that we look at investments, you know, we're going to talk about the capital stack again and why a pref equity investment makes sense over a common equity, but we'll kind of get into how we look at deals.
Yeah. This is super important. We're going back to this slide because I want to point out a couple things here. There's really 2 things. One, the position that the preferred equity is in. So we have the common equity behind us. So that's one thing I want to point out. And I think we identified that early on in the presentation. Number 2, the thing I want to point out is that if you are getting let's just say a 12% return as an investor, contracted, paid quarterly, would you take the chance of getting in that position versus a common equity that's maybe paying you 10, 12, 14%, but you're behind the preferred equity? So we look at these things all the time and literally from a risk reward and opportunity, a 20% return, greater return than you would on a common equity, the way things are penciling today. You know, and I still have people that are investing in some common equity deals. I wouldn't do it based off what I've seen. I like this position of the preferred equity, and I like the ability to be in and out of this. And I like that kind of seniority to the common equity. And I like that preferred component being we're paid before the common equity is.
So in this preferred equity position, I've had a couple investors ask, what do I look for? If I'm evaluating some preferred equity investments side by side, what are some factors that I look for?
Yeah, that's good. And I want to point something else out here. Look at in 2023, we showed the preferred equity at 10% and the senior debt at 60. One thing is really important to look for when you're evaluating preferred equity. You don't want your common equity number and your preferred equity number to be inverted. Okay. So we will go up to about 75, 80% of the capital stack, making sure we still have 20% of common equity behind us.
Behind the senior debt and preferred equity.
Correct. Yeah. So, we don't want to be 30% preferred equity and 10% common. That's not a lot of security. We want to be 30% common, 10% preferred.
Mhm.
And that way we know that there's the equity behind us. So any event that something doesn't work out, that we're in the right position to be capitalized and paid our full investment plus our return.
Mhm. So before we get into kind of that future outlook, let's talk about some of the publications and news that have been featuring some preferred
All right,
equity.
so I'm gonna share something. I hate it when people read slides. I get bored, but we're gonna read slides. Well, this slide we're gonna read. Okay, I think this is really important. Hearing from industry people about preferred equity and what's happening in the market today. But I'll take that top one there. It's from Multi-Housing News. Preferred equity is pouring into multifamily, and that's true because it's needed today. It wasn't needed 10 years ago, 5 years ago. But I'm going to read that. Preferred equity, a once sideline mode of financing, is attracting new investors due to the higher than average returns it offers them. So it was on the sideline. It's needed today. Investors are making good money. They're protected. Plan on seeing preferred equity is one of the favorite investment tools for the next couple of years.
Yeah, and Real Estate Capital USA has a headline: preferred equity becomes the preferred lifeline. We've talked about rescue capital. We've talked about this loan maturities coming due. While that sounds very, very scary, and in some cases there's opportunities to find a solution for a win-win situation. And so the structure is becoming the place more lenders or investors want to be in the capital stack.
Yeah, I mean, it makes sense. You want to be in a senior position, but you still want a good return. So, and the senior debt's not just going to go away. They obviously they have it structured so that doesn't happen to them. But that next one from Globe Street: preferred equity takes center stage. Regarding solutions for refinancing floating rate debt, panelists agreed that preferred equity is the go-to strategy, and this is exactly what's happening. There are billions of dollars of floating rate debt that were taken out, 2, 3, 4 years ago. And that rate was running at 3.5, and now it's running at 8. That's expensive money, especially when you're on the tail end of a construction project and you've drawn out $40 million. That can be super expensive. So that's where preferred equity is coming in to help these guys.
Yeah. Lastly here, Commercial Search says preferred equity and private credit here to stay. And from an investor's point of view, preferred equity returns today are perceived to be closer to standard equity joint venture returns without the risk.
Well, and that's just what we talked about in our graph, being ahead, getting 12% and your common equity, 10, 12, 14. It's not worth the risk, because you're in a much better position on the preferred equity. So what does all this mean? And this was taken directly from our investors. This, we've been doing this over 10 years. We have several hundred investors that have been with us. But the thing that we heard over and over again was, we're looking for more cash flow, but we don't want 3, 4, 5%. We can go get a treasury, so we want something that's really safe, really secure. So, we've got double-digit returns. We start quarterly distributions. We're in a senior position to the common equity in the capital stack. These investments are typically maybe 1.5 to max 3 years. So I consider that short term. So you're kind of on the sideline, but you're in the game without as much risk as common equity. And the last thing there on the bottom right I want to point out is this isn't just a kind of one and done. Not only do we have deal flow, we're getting several calls a month to evaluate pref equity deals, but we're going to talk a little bit more about what the upside opportunity could be after the deferred equity contract terms out.
Let's talk about the how and what. How are we looking at investments? Why are we doing this? I know we touched on it, but let's talk about it in further detail.
Yeah, I think we need to emphasize this. You know, if you look at the type of deals that we're looking at, you know, we're not just kind of out there throwing money at any given deal for preferred equity. You know, it's the opportunities there. Developers have good projects, good product, and we're like 2008 and 9 was distressed. Okay, this is discounted. I don't see a complete mirror of 2008, 2009 because the banking world is much different, and we learned a lot of lessons from back then. But you know, there's good projects, but people need some short-term capital to bridge this kind of maybe 1 to 2 year gap until things start settling down and rates normalize and rents normalize and the supply chain and. So we're providing the developers with a solution, but we're also providing our investors with a solution. So it really is, you know, it's an opportunity for both parties to benefit from the transaction. You know, our investors, I just said this earlier, you know, that they said, hey, if it's 5 and 6%, I'm going to the treasury, you know, but they feel really good about being in a Class A project, state of Texas, earning 10, 11, 12%, and being in a position to do something different, bigger and better as we go forward, which I think is really important right here to understand. We don't pick up projects that are student housing in Oregon, or it's a Class C rehab in Michigan. That's not us. We are underwriting every asset as if we were going to own it. So we go through a complete underwriting due diligence, just like we were going to buy it today. And we look at the numbers, and we forward look at, you know, interest rates, timing, rent escalation, supply demand numbers, migration numbers, everything. But we look at this just like we're going to own it, because quite frankly, if we can, we will, you know, and that'll be our kind of our end game. And that brings me down to, you know, why are we doing this? If I can get paid as an investor 12% to be in a pretty safe and secure position and get a front row seat to the asset's performance from property management, asset management, understanding the nuances of the asset itself, I'll do that all day, every day. Now, if we don't acquire it, guess what? We term out, we get our money, we move on. But if I go to the developer and say, hey, we'll buy it at this price, you don't have to take it to market, you don't have to take broker fees, and your loan's terming out and you may not have another option, it's an acquisition for us. And so that's what we're looking to do. Now, will that happen? Maybe, possibly. Will it happen on all of them? Probably not. You know, but if we can pick up a couple of assets a year for the next few years, that'd be a home run.
Yeah, I think, you know, and that strategy really just speaks back to the underwriting based on ownership, and not just you know, source to deploy money that doesn't quite make sense. You know, it's a really thoroughly vetted investment.
Yeah.
So wrapping up, you know, here's an overview of the track record. You know, this is a snapshot of the past 10 years. And, you know, I want to point out that a lot of these investments were common equity investments, and what we're really talking about is preferred equity. So that hold term of 4 years, a little over 4 years, is probably not going to be, you know, what these investments that Club Capital is doing in the pref equity space is going to show. But, you know, it's reputation, its track record, and experience, which is really important to focus on when you're vetting a sponsor or a place to deploy your money.
Yeah, I mean, this is, you know, what we hope to do is when we come out of this kind of pref equity environment and the deal makes more sense, is to get back into the acquisition and managing those assets for cash flow. And the reason we sold those in the 4-year mark is there was just crazy money chasing deals. I don't think that's going to happen again. I think we buy them at a great price, and I think we end up cash flowing them and then refinancing, pulling cash out and cash flowing them again. One thing I think super important to point back out is the loans that are maturing. I can't stress that enough. It's just now starting, and like I mentioned, there's $600 billion in multifamily loans starting to mature over like now for the next 24, 36 months. Those are all going to be opportunities because I don't think the market, with everything that's got to happen, it would have to line up perfectly. Interest rates, valuations, rents, just supply, demand, growth. There's so many things. It will happen, high probability, but it's still going to take another couple of years for, I think, everything to normalize. So right now is take advantage of this opportunity to put yourself in the right position at the right time, making some money while you're getting ready to capitalize when this thing turns, like we showed in 2026, when the supply demand metrics reverse, and we're going to have more demand than supply.
Well, thank you so much, everyone, for joining us. We appreciate your time and would love to be available for any questions you have. If you want to dive into any of the information that we've shown you here today, feel free to reach out to Club Capital, info@clubcapital.co.co. And once again, thanks so much.
Yeah, and I want to wrap it up just by saying I get asked is, hey, Darin, when's the best time to invest? And I say, guys, you can never pick the best time. But when we kind of showed you the numbers on construction starts, supply, demand, use the data. We're looking at the couple projects we have right now, and we have 4 more, I think, between now and the end of the year. We have 2 right now, but those things are so well positioned, and there's some other nuances to them that I think give them great, benefits and features to the investors. But the time is now. Start finding some really high quality assets with some qualified sponsors that are doing pref equity, because there's going to be a lot of opportunities out there. And I think you're going to have a lot of choices if you're with the right group. So that's my closing comments. And again, thank you very much for spending the last half hour or so with us. And to Allyson's point, please reach out, call us, call her, call me, email us. We're available. Thank you.
Thank you.